So hello. Hello friends. So today we are going to discuss the Indian market review from July 14 to 18, 2025, and we will also look for the outlook for the coming week from July 21 to 25, 2022. So the Indian equity market experienced a challenging week from July 14 to 18, 2025, extending a losing streak that culminated in the third consecutive week correction. Both the Sensex and Nifty closed significantly lower, with the Nifty 50 breaching the crucial level. So, guys, you can tell me if you are able to hear me. So, okay, so I think you all can hear me. So, yeah, let's continue. Both the Sensex and Nifty closed significantly lower, with the Nifty 50 breaching the crucial 25,000 mark. This downturn was primarily influenced by sustained selling pressure from foreign institutional investors (FIIs), a generally disappointing start to the Q1 earnings session, particularly from key information technology (IT) companies, and ongoing global trade uncertainties. While the broader market faced headwinds, defensive sectors such as FMCG, So so there was a problem with the IT sector and ongoing trade uncertainties. While the broader market faced headwinds, defensive sectors such as fast-moving goods, FMCG, and pharmaceutical demonstrated notable resilience, attracting investor capital amidst the prevailing cautious sentiment. Looking ahead to the week of July 21-25, 2025, the market trajectory will largely depend on the continued flow of Q1 earning reports, especially from major financial institutions and other large companies. Crucial macroeconomic data release, including the infrastructure output and purchasing manager index PMI figure, are anticipated to provide further direction. Technical support and resilience level will play a significant role in short-term trading, and the preservance or reversal of FI flows will remain a key determinant of overall market sentiment. The market's sharp reaction to the Q1 earnings, particularly the negative sentiment surrounding the IT and financial sectors, coupled with rotation of capital so money is rotated from the IT and other to the sectors to the FMCG and others. So let's start with the Indian market performance from July 14 to 18, 2025. So the Indian equity market recorded their worst weekly performance in nearly 2 months during the period of July 14 to 18, marking the third consecutive weekly decline for benchmark indices. The selling pressure intensifies throughout the week, leading to significant correction across the board. Benchmark indices Sensex and Nifty on Monday, July 14. The Sensex opened the week on a negative note, dropping 247 points or 0.30 to close at 82,253.6. Similarly, the Nifty declined by 67 points or 0.27, settling at 25,082 rupees. This initial decline extended for a 4-day losing streak, during which Sensex has already tumbled 1,459 points and the Nifty 50 has slid nearly 2%. By the end of the week on Friday, July 18, the bearish sentiment deepened, with the Sensex settling 501 point lower, a 0.61 drop, to close at 81,757. The Nifty 50 also fell by 143 points, or 0.57, extending the week at 24,968, notably breaching the psychological significant 25,000 mark. Cumulative for the week of July 14 to 18, the Sensex experienced a decline of 605 points, or 0.73%, while the Nifty plunged by 103 points, or 0.41%. The consistent decline over the four trading session, the third consecutive weekly correction, accumulating in the Nifty breaking the 25,000 level, indicate a strong and sustained bearish sentiment. This suggests that the market is grappling with more than just short-term jitters. It points to a re-evaluation of risk and potentially a shift in the broader market trend. A sustained losing streak and the breach of major round numbers like 25,000 for the Nifty are not just numerical changes, they significantly impact investor psychology. This signal a loss of confidence, potentially triggering stop losses and further selling. So, now let's see what the sectoral performance review of. So, what sectors are performing how? Let's see that. The week saw a broad-based decline, with nearly all major sectors except metals ending in negative territory by July 18. Financial stocks were among the hardest hit, leading the decline. Prominent leaders like Axis Bank, Shriram Finance and Kotak Mahindra Bank were significant losers, contributing to a 1.46% slip in the Nifty Private Bank Index and a 0.66% drop in the PSU Bank Index. Now let's go to the IT sector, see how it performed. So IT sector experienced substantial selling pressure, declined by 3.76% overall. Major IT companies including Wipro, Infosys, Tech Mahindra, HCL, Technology and TCS saw average decline of 1.5%. The defense sector also witnessed heavy profit booking, with stocks such as Bell, Data Pattern and HAL experiencing sharp decline. This extended the sector's recent weakness as investors locked in profit following strong rallies in previous month. In stark contrast, the FMCG sector emerged as a standout performer, registering gain exceeding 2%. So this outperformance was attributed to positive management commentary on urban demand recovery and robust rural consumption pattern. Key beneficiaries within this sector includes Hindustan Unilever, ITC and Nestle India. The pharmaceutical sector also gained traction, rising by 0.7%, supported by defensive buying pattern and a stable business outlook. The stark divergence in sectoral performance, with defensive sector FMCG Pharma outperforming, while growing oriented sectors IT, finance, defense decline, clearly indicates a risk of sentiment dominating the market. FMCG and Pharma are typically considered defensive sector, meaning their demand is less elastic to economic cycle. Their outperformance during a market downturn suggests investors are prioritizing capital preservation and stable return over high potential. This rotation of capital toward perceived safer havens reflects concern over future earning in cyclic sector and a cautious outlook on market volatility. So let's talk about what foreign investors FIIs are doing in this have done in the previous week. So FIIs exhibited a mixed trend throughout the week, but were predominantly net seller. Significant outflows were recorded on July 14, 16,000. Yeah, July on July 14, July 16. On July 14, they sell 1 lakh 6 1 1,614 crore. On July 16, they sell 1 lakh 8,058 crore. And July 17, they sell 3 3,694 crore. Overall, FII have offloaded Indian equities worth 10,775 crore so far in July. Conversely, domestic institution DI maintain a strong buying instance, acting as net buyer throughout this week. Their inflow included 1,787 crore on July 14, 1,550 crore on July 15, and 1,223 crore on July 17, and 2,820 crore on July 17, and 2,103 crore on July 18. The persistent and significant FII selling was a primary driver of market weakness, signaling a lack of conviction from foreign capital in the Indian market near-term prospects, while robust DI buying acting as a crucial counterbalance, curbing sell-off tremendously. It was ultimately insufficient to fully absorb the FII pressure, leading to the overall market decline. The fact that the market continued to decline despite a strong DI means the magnitude of FII selling was greater, or FII selling was concentrated in high impact stocks. This indicates that while domestic investors have confidence and willing to buy on dips, their purchasing power or strategic intent is not yet strong enough to fully offset the foreign outflow. This creates a market environment where FII sentiments continues to be a dominant factor, and a reversal in FII flow shows a crucial turning point for a sustained recovery. So if we see sectoral by snapshot, so FMCG sector increased by 2%, pharmaceutical increased by 0.7%, IT sector declined by 3.76%, defense sector is also significantly declined, private sector declined by 1.46%, and PSU bank declined by 0.66%. So overall, all the sectors were red only. So key influential factor of the past week. So let's discuss what were the key factors by which market was down. So Q1 earnings season was one of the factors. So the initial phase of the first quarter earning largely failed to instill confidence among investors who awaited more comprehensive corporate results for clear market direction. So Reliance Industries stood out with exceptional Q1 result, reporting a record consolidated net profit of Rs 26,994 crore, making a 78% year-on-year increase. This robust performance was primarily driven by strong growth across its consumer business and a significant one-time gain of 8,924 crore from the sale of its stake in the Asian Paints. In contrast, TCS delivered a disappointing performance in the IT sector, with Q1 revenue declined by 3.3% sequentially in constant currency terms. Despite securing strong deal wins totaling $9.4 billion, the revenue conversion remained weak due to slower project ramp-ups, client spending cuts, and project delays, contributing significantly to the broader IT sector's decline. Other major IT companies reported similar challenges, accelerating the negative sentiment. Another bad news came from Axis Bank Q1 result significantly missed street expectations, leading to a sharp 4.5% decline in its stock price. So, concern arose from higher than expected provisions, slower loan growth, and a contraction in net interest margin, while not fully impacting the market within the July 14 to 18 windows. So, HDFC announced its Q1 financial year 26 result on July 19, reporting a 12% year-on-year rise in standalone net profit to rupees 18,155 crore. Its net straight interest margin grew by 5.4% to rupees 31,040 crore through the core NIM was slightly lower at 3.5% compared to previous quarter. On a more positive note, ITC Hotels shared gain over 2%, extending a rally for the third consecutive day after reporting a 54% year-on-year jump in Q1 financial year 26 profit, with revenue growing by 15.5%. Similarly, Raymond's share saw a positive outlook, with Antique Stock Broking initiating coverage with a buy rating and suggest a potential 30% rally, highlighting the company's strategic shift toward precise manufacturing. The mixed Q1 earnings, particularly the underperformance of IT and some financial heavyweight, acted as a direct catalyst for the market downturn. While a strong result from Reliance and positive performance in specific companies like ITC Hotels provide some counterbalance, the overall sentiment was dominated by the negative surprise from large cap sectors. This indicates that market participants are highly sensitive to earning disappointment from bellwether companies, especially in sectors perceived as growth engines, leading to broader market corrections. The market is clearly penalizing companies that fail to meet expectation. Even if overall results are not catastrophic, the market overall decline, despite some strong earning highlights, that the negative surprise from large in financial sectors are weighting more heavily. This suggests that market expectations for these sectors were high and any miss, even if minor, triggered significant repricing. The market is not just reacting to absolute numbers, but to the deviation from expectations and the sectoral weight of companies reporting. Now let's talk about the macroeconomic developments that took place. Several macroeconomic indicators provide a mixed picture. Easing CPI and WPI inflation offered temporary relief and reinforced expectation that the Reserve Bank of India would maintain an accommodative stance in the near term. So the RBI has previously cut the repo rate by 50 basis points to 5.50 in June 2025, significantly changing its monetary policy instant to neutral. This marked the third consecutive rate cut aimed at stimulating credit growth and supporting the overall economic fundamentals. Additionally, the cash reserve ratio was reduced by 100 basis points to 3%, a move expected to release 2.5 lakh crore of primary liquidity into the banking system. So on the extended front, uncertainties around US-India trade negotiation continued to weigh on market sentiments throughout the week. Furthermore, President Trump's threat of imposing significant tariff on the European Union and Mexico contributed to broader global market decline. Despite positive macroeconomic signals like easing inflation and a significant RBI rate cut aimed at boosting credit and growth, the Indian market continued its decline. This apparent contradiction suggests that immediate corporate earnings disappointment and FII outflow outweighed the positive macroeconomic backdrop. The RBI shift to a neutral stance, while supportive of growth, might also be interpreted as less aggressive dovish than the some market participants might have hope, contributing to tempered optimism. This indicates that fundamental corporate performance and capital flows are currently more dominant drivers than broader macroeconomic improvements. The market's muted response to positive macro data, coupled with a strong negative reaction to earnings and FI outflow, indicate that current investor focus is heavily tilted toward micro level corporate performance and capital flow dynamics. While macro stability is a prerequisite, it is not a sufficient condition for a rally when company specific or capital flow headwinds are strong. So, to the cut story short, like market flow will largely depend on the company's result, which are coming in the next week. They are heavily depend on that. So now let's talk about the global market trends. So international market displayed mixed performance, reflecting the prevailing global uncertainties. European share experienced a decline primarily driven by President Trump's renewed threat of imposing significant tariff on the EU and Mexico, which particularly impacted the automobile sector. Japan's Nikkei index also ended the week lower. The broader global economy continues to face uncertainty stemming from US trade policy, a strengthening US dollar, and various geopolitical risks. So, global trade tension, especially the renewed threat of tariff from the US, are creating significant uncertainty that transcends national border, impacting even the Indian market. This highlights India's increasing integration into the global economy, making its market susceptible to international political and economic development. The direct mention of Trump's tariff threat impacting European Union market and the general reference to the global trade uncertainties affecting Indian indicates a strong interconnectedness. This implies that even domestic fundamentals are sound, external shock or policy shift from major global players can create significant headwinds for the Indian market, particularly through FII flows and export-oriented sector. This necessitates a more integrated global local analysis for market outlook. So let's discuss about the significant corporate action by July 14 to 18, 2025. This week also saw several significant corporate actions, including dividend announcement, bonus issues, and IPOs, which influence specific stock movement and overall market sentiment. So, major dividend announcement and ex-dates. Several companies as ex-dividend dates during the week of July 14 to 18, requiring shareholder to hold shares before this date to qualify for dividend payment. So notable announcement includes Dr. Reddy's Laboratory, rupees 8 per equity share with an ex-date of July 10, 2025. Lakshmi Machine Works, rupees 30 per equity share, ex-date was July 10. Wales India, 7.03 per equity share, ex-date was July 10, 2025. Diffusion Engineers, rupees 1.50 per equity share, and ex-date was July 10, 2025. Pfizer announced a special dividend of rupees 130 and a final dividend of rupees 35 with a record date of July 9, 2025. Infosys declared a dividend of rupees 57 with a record date of July 9, 2025. So Tata Consultancy Services announced an interim dividend with a record date of July 16, 2025. Coromandel International Limited declared a special dividend of rupees 3 and a final dividend of rupees 6 with an ex date of July 17. Happy Forging Limited recommended a final dividend of rupees 3 with an ex date of July 2025. Grapes Graves Cotton Limited announced a final dividend of rupees 2 with an ex-date of 23 July. Novartis India declared a final dividend of 25 rupees with an ex-date of July 23. The high concentration of ex-dividend dates from numerous companies, including prominent ones during and immediate following the review week, suggests that a portion of the selling pressure observed could be attributed to dividend stripping. This is a strategy where investor buy share before the record date to receive the dividend and sell immediately after the ex date, which can contribute to short-term price volatility and downward pressure on individual stocks and cumulatively on the broader market. When a stock goes ex-dividend, its price generally drops and by roughly the dividend amount. If many large cap stocks have their ex dates clustered, this can contribute to overall index decline even if the underlying company fundamentals are stable. So crux is that if a large companies have dividends date announced, so due to dividend after record date their price down, so in spite of like due to their price down, so market will go down. uh, Otherwise if their fundamentals are strong also, but due to the record date their price will go down, so this gives a false negative about the market performance. So let's talk about the notable bonus issue and record dates. So HDFC made a significant announcement regarding its first ever 1:1 bonus issue. This means shareholder will receive one fully paid up equity share for every one share they currently hold. The record date for this bonus issue is set for Wednesday, August 27. Ashok Leyland also announced a 1:1 bonus share issue. So HDFC Bank's decision to issue a 1:1 bonus is first ever, is a significant corporate signal. While bonus issue do not change the intrinsic value of a shareholder's holding immediately, they increase the number of outstanding shares, which typically improves liquidity and can make the stock more accessible and attractive to retail investors by lowering the per share price. This move reflects the bank's strong financial health, confidence in its reserves, and commitment to rewarding shareholders, potentially fostering long-term investors' confidence despite short-term market volatility. A bonus issue, particularly a first-time one from a major financial institution, signals strong reserves and a healthy financial position, indicating management's confidence in future profitability and ability to retain earnings while still rewarding shareholders. So other corporate developments are, despite the challenging secondary market conditions, the primary market continues to show activity. Travel Food Service Limits listed at a 2% premium over its IPO price on the BSE. Yeah, Sevi Infra and Logistic is also set to open on July 21st in terms of merger and acquisition or investment. SIS Limited Board approves an investment of up to increment 8 crore in Instalco Wi-Fi Technology Private Limited. So the continued activity and even premium listing in the primary market IPOs despite a downturn in the secondary market suggests a discerning but still present investors' appetite. This indicates that capital remain available for fundamentally strong business or attractive new offerings, implying that the market's current weakness is more about broad-based sentiment and specific sector challenges rather than a complete drying up of investment interest. Investors are becoming highly selective, favoring quality and compelling growth stories. A robust primary market, even when the secondary market is struggling, suggests that investors are not entirely risk averse. Instead, they are highly selective, directing capital toward new opportunities that present clear growth perspective or attractive valuation. This indicates that liquidity is not an issue, but rather investors are relocating capital to specific high convincing player, implying a more mature and discriminating market than a panic driven one. So now let's see the outlook for the July 21, 25, 2025. So let's see what is going to happen in the next week, what all triggers we have. So the triggers are: the upcoming week is poised for continued market activity with several economic data release and corporate earning announcement expected to shape investor sentiment and market direction. So upcoming economic calendar, if we see, so on Monday 21st 2025, infrastructure output year on year June will be released at 11:40 am. On Wednesday July 23, M3 money supply year on year is scheduled for release at 11:30 am. On Thursday, flash purchasing manager index PMI data for July will be released, including HSBC composite PMI flash, HSBC manufacturing PMI flash, and HSBC service PMI flash at 5 am. So let's see what all these effect will have on the market. Will these numbers enhance the market or they make the market go down? We have to wait and watch. On Friday, foreign exchange reserve will be updated at 11:30 am. So the release of flash PMI data for July will be a critical indicator for assessing the health and momentum of India's manufacturing and service sectors. PMI is a leading indicator of economic activity, providing a quick snapshot of business conditions. Any significant deviation from consensus forecast could trigger market reactions, influencing investor sentiment regarding economic growth and corporate earning prospect for the current quarter. A strong PMI could signal resilience, while a weak one could exacerbate concerns. Therefore, these releases are not just numbers, they are forward-looking signals that can directly influence market sentiment and specific performance. So, let's discuss about the anticipated corporate earning results coming in next week for the companies. The Q1 financial year 26 earnings season will continue be to a major market driver in coming weeks. Several key companies are scheduled to announce their results. So Reliance Industries has already announced its result on the Friday, but its overall impact on the market we can see on Monday. Yeah, Infosys, a major IT player, its earning will be closely watched after TCS disappointed performance. ICICI Banks, a significant financial institute, its results were is out, but let's see what it effect will have on the Monday market. Yeah, the result was good, but let's see. It beats all the estimates, but see, let's see what it has effect on Monday. Yes Bank, another sector bank in Tally whose performance will be under scrutiny. HDFC Bank also announced a result on July 19th. Market full traction will unfold in the coming week. So Dr. Reddy's Laboratory, a key pharmaceutical company, its earnings will offer insight into defensive sectors' performance. Bajaj Finance, the most weighted company whose result we are waiting for, will have a significant impact on the market, a major non-banking financial companies. So which result is very important for the market? Let's see. Nestle, another FMCG giant, a prominent company, its earning will indicate the strength of urban and rural consumption. Cipla, another pharma company whose performance will contribute to the sector's overall outlook. So the upcoming Q1 earning from these large cap company, particularly the financial sector heavyweights, ICICI Bank, HDFC and other IT giant Infosys, will be paramount in shaping market sentiments. The previous week saw IT and financial as major laggards due to disappointing earnings and concerns. If these companies deliver better than expected results or provide positive guidance, it could act as a stronger counter narrative to the previous week bloom, potentially leading to a sector rotation back into these segments and a broader market recovery. Conservatively, further disappointment could reinforce negative sentiments. Yeah, and this makes their earning a pivotal event for the market near term indicators. So, let's talk about the potential market drivers. So, several factors will continue to influence market movement in the upcoming week. So, we will talk about the technical levels, FIDI trends, global cues, and sectoral focus. On which sectors do we need to focus? FMCG and Pharma, IT and financials. So let's discuss all these in details. Yeah. So technical levels, Nifty's crucial support zones are identified at 24,978 and 24,850, 24,676, 24,538 and 24,450. Key resistance levels are at 25,080, 25,147, 25,320, 25,434. So market can go in either both the direction. So these are the major resistance and support levels. The market behavior last week demonstrated that both price levels and specific time zones are crucial in short-term trading decision. The emphasis on a specific technical support and resistance level suggests that short-term trading will be heavily influenced by chart pattern and algorithm trading. The market movement around these levels, coupled with the ongoing FI selling pressure, will determine whether the recent downturn extends or finds a floor. So, the interplay between technical factors and FI floors will be crucial. A break below key support level amidst continued FI selling could accelerate decline, while a strong DI buying at this level could signal potential reversals. So let's talk about the FIDI trends. So foreign institution FI flows will remain a critical factor. The sharp increase in FI selling has amplified the market weakness. Continued outflow could sustain the bearish pressure, while a reversal in this trend could provide a strong tailwinds for the market. Domestic institution DIS buying will continue to provide a crucial domestic cushion as observed in the previous week. So for global cues, particularly development in the US trade talks and broader geopolitical event will continue to influence market sentiment. So in global clue, trade deal will be a major deciding factors what market will go in which direction. So trade talks for India is also going with the US. Daily Trump is announcing that we are very close to make a deal, but let's see where the deal goes and come and who is more benefited, India or US. Accordingly the market will react. For sectoral focus, we have to focus on FMCG and Pharma. These sectors are likely to remain defensive bets, potentially continuing their outperformance. If broader market uncertainty persists, IT and financial, these sector will under intense scrutiny due to ongoing Q1 earning announcements. Any positive surprise from this heavyweight could lead to a rebound. while further disappointment could exaggerate sector specific and broader market decline. So in IT, due to the um, global factors, mostly our Indian IT companies work for the US client, and due to trade tariff and uncertainty, their client uh, are not deciding on their future, so they are cutting on their IT spendings, which led to the uncertainty in the outlook of these companies, so they are not able to declare what will be their future. So this uh, will lead to somewhat underperformance in the IT sector. So the upcoming will be a test of whether the flight to safety into FMCG and pharma continues, or if positive earnings surprise from IT and financial can trigger a rotation back into these growth oriented sectors. The market previous rotation into defense sector, FMCG, pharma was a reaction to uncertainty and disappointing growth sector earning. For the defense sector, due to the India-Pakistan wars and other wars going on, global wars going on like Russia-Ukraine and so due to these wars, their growth was like these companies have gone much far, so their price are so much elevated right now. So when these wars stop, so there is a downturn in that, so people are booking their profit in these defense sectors. So right now defense sector is looking FMCG, and FMCG is the most defensive, and consumer also. So let's see what happens. This would indicate a broader market shift from risk aversion to renewed growth seeking, making the earning report from this key sector pivotal for determining the market's overall characters. So once again, we can recap the Indian economic calendar. So on Monday, July 21st, infrastructural output year on year, it's very important, and previous value was increased by 0.7%. On Wednesday, M3 money supply year on year will its importance is medium, and previously it was at 9.6%. HSBC composite PMI flash, its importance is high. So how the PMI sector is performing? So HSBC manufacturing PMI flash, it is also high. Its earlier its was value was 58.8. So 50 value above 50% indicates a high manufacturing growth in the country. So let's see what this number comes. So HSBC service PMI flash, so its value was previous, its also importance is high. So how our service sector is performing, it indicates that value. Its value, previous value was 60.5%. And foreign exchange reserve, it's medium. How our foreign reserve is, so its earlier value was $696 billion. So and the major corporate earning companies which will show their result for next weeks are Infosys. ICICI Bank has already given the result. We will see its on Monday how it performs. So Dr. Reddy's Laboratory, Bajaj Finance, Nestle and Cipla. For investment consideration and recommendation. Given the recent market volatility and sector-specific challenges, a well-diversified investment approach remains paramount. Mutual funds offer inherent diversification by investing in a variety of securities across different sectors and companies, which help to mitigate risk and protect portfolios from market swing. So the people who are investing in the mutual fund, this is the good time, because when the markets are down, when you buy with the same amount you get more units. So in the same amount you accumulate more units. So for a long term, equity market will outperform. So for a short term, you don't have to do, you continue with your SIP. If you have extra money, so you can put more money while the markets are down. So these will benefit you in the long term. So you will get more units. So these fundamental benefits from professional management, as they are overseen by experienced fund manager who make informed investment decision based on through market analysis. This aspect is particularly beneficial for investors who may not possess the time or a specialized expertise required to manage their own portfolio effectively. As we see, the market is very volatile, so we cannot track the market uh, in our basis. So here comes the mutual fund to our rescue. So their fund manager is there who will manage your money, so they are observing the market and they know when to invest. So we have to just simply follow our SIP, and if market goes down, we have to just put more money. So mutual fund also stand out for their affordability and accessibility, providing a low cost avenue to access professional money management and diversified portfolios. So it, with very less money also, we are getting the world India's top mutual fund managers. So they are working for us while we are sleeping. They are managing our money. So investor initiate investment with modest amount, often as little as 100 to 500 per month, through systematic investment plan. Furthermore, most mutual funds offer high liquidity, allowing investors the flexibility to easily buy and set units at NAV related price, providing ease of withdrawal when financial need arises. So mutual funds are also liquid. Whenever we need, we can sell the mutual fund in cash. They are very liquid, and within T plus 1 or T plus 2, you will get the money back. So they are very liquid, unlike the real estate, where to sell your plot or land, you have to wait for 1 month, wait for the, because they are very large ticker size. So real estate investment is also good, but they are not liquid as these mutual funds. So investor has the flexibility to choose between systematic invest SIP for rupees cost averaging and long-term wealth creation, or lump sum investment for large amount to capitalize on specific market opportunities. Regardless of the investment method, it is crucial for investor to understand and compare the fee associated with mutual fund. This include expense ratio, which are annual fee for managing the fund, and exit loads, which are fee for premature withdrawals. So before investing in the mutual fund, we should see these fees which the fund manager takes for managing your fund. So that is expense ratio. We should go for a fund with less expense ratio, but we should also see if the fund is performing or not, and also exit load if it doesn't have, if we withdraw money within a limited period of time, so then the exit load is there. So we should check all these fees before deploying our money. Additionally, certain mutual funds such as equity linked saving plan (ELSS) offer tax benefit through deduction under Section 80C of Income Tax Act, although these funds typically come with a lock-in period. So in a volatile and uncertain market environment characterized by FI outflow and mixed corporate earning, hybrid mutual fund emerge as a particularly suitable investment option, especially for beginners or cautious investors. Their balanced allocation between equity for growth, participation, and debt for stability and risk directly address the risk of sentiment observed in the past week. The market current state, volatility, FI selling, rotation to defensive sectors implies a heightened need for risk management. Hybrid mutual funds, by their very nature, combine equity and debt, offering a balanced approach. This makes them an ideal choice for investors seeking moderate return with controlled risk, directly aligning with the market current demand for stability without completely missing out on potential upside. The strategy allows investors to participate in the market upside while migrating the sharp downside. So now we will discuss about the corporate actions coming for the next week. So we will just start the corporate actions. Uh, just give me 2 minutes. So we will start with the corporate actions. So for the ex dividend dates on Monday, uh, which companies are give focus business solution, it will give bonus issue, record date will be July 21st. On Wednesday, July 23, Aditya Birla Sun Life AMC will give dividend, and Sonata Software will also give the final dividend. On Thursday, July 24, Cholamandalam Investment and Finance Corporation India, they will give the final dividend. So I will also let you know the amounts, what amounts they will give. So thank you everyone for joining in the live session. So tomorrow for corporate action and for tomorrow evening I would be providing you the details. So good night for today. Thank you everyone for joining the today's live session. So if you have any uh, you can comment me whatever you want me to cover in the live session, so tomorrow we can connect at 9 p.m. tomorrow. So please comment me on what topics you want me to make the video, and also go live for I can also help you in your portfolio reviews and other things. uh, so to go for which mutual fund or anything, like by accessing your risk profile, what your risk profile is, and according to you can add this mutual fund to your accounts. So and also let me know if you want videos in how to invest in mutual fund and all those steps. So for that also I can take a live session, step by step how to do that. Yeah, so thank you for today, and please do let me know in comments so I can come tomorrow live with all those. Or you can also comment in my videos or community videos, you can comment me so that I will take all those comment and try to go live or make a special video for that.